Welcome back to the deep dive. Today, we're looking at something potentially huge from Coinbase. They've just launched a new regulated public token sales platform. A lot of people are calling this maybe the defining moment for digital finance this decade.
That framing, I think, is spot on. This is way more than just, a new feature. It feels like a major financial milestone.
Hmm.
It's really about trying to pull the digital asset world into the mainstream financial structure.
Right.
So for you listening, our mission today is pretty clear. We need to break down this new structure, understand what it really means for industry legitimacy, and crucially, how it might change your access to those early investments.
The kind that until now were mostly off limits unless you were a VC or, a whale.
Exactly. Venture funds, accredited investors, insiders,
Sure.
that was the old game.
Okay, so let's get that core context straight. Coinbase, biggest U.S. crypto exchange, is basically trying to open up early access to new digital tokens for potentially millions of its regular U.S. users.
And the history here is really fascinating, maybe even a little heavy. This is the first time we're seeing a legitimate, regulated path for public token sales for U.S. retail since the whole ICO boom and bust.
Ah, the Wild West of 2016 to 2018?
Precisely. The initial coin offering era. It ended pretty abruptly in 2018 with regulatory crackdowns, scams everywhere, pump and dumps, just pure chaos and speculation, really.
So Coinbase is bringing the idea back, but with presumably a lot more rules.
That's the entire point. Compliance, guardrails, structure. That's the mantra this time around.
Okay, let's focus right on those guardrails then. How is this platform actually different? Because it's definitely not just a typical listing on the exchange, is it?
No, not at all.
Mm-hmm.
Process is very deliberate. First off, forget the mad dash, the FOMO of the old ICOs. Investors get a specific one-week window. Plenty of time to request an allocation for the new token.
1 week, okay?
And the allocation itself, this is where you see the democratic intent. It's algorithmic, it's transparent, and crucially, it is not first come, first served.
Right, that's a huge difference. How does that algorithm actually stop the big players, the whales, from just grabbing everything?
So they're using what they call a filling up from the bottom approach. It's kind of like, imagine sharing a pizza. They make sure everyone who asks gets at least a small slice, a minimum allocation, before anyone gets seconds.
Ah, I see.
So the whales, the big buyers, they only get larger amounts after the smaller requests are satisfied. It's designed specifically to get the tokens into as many hands as possible and limit that concentration we saw before.
That sounds like a direct response to the VC dominance back then. Okay, practical stuff. Purchases have to be in USDC, USD coin only.
Yes, only USDC.
Why just a stable coin?
Well, that's a really smart move from a regulatory and operational view. USDC is, highly regulated, fully reserved. Using it cuts down on regulatory friction right away.
Makes sense.
It simplifies the whole know your customer, KYC, and anti-money laundering, AML side of things too. Plus, predictable liquidity for the project raising funds. They don't need to deal with volatile crypto prices or tricky bank transfers during that crucial initial sale. It makes the whole thing cleaner.
And the pace. They're aiming for about 1 token launch a month to start. Sounds cautious.
Fairly conservative initial pace. And importantly for users, Coinbase isn't charging you any participation or listing fees.
Oh, really? So how do they make money?
They take their cut, a percentage of the USDC raised from the issuer's side, from the project selling the tokens. So for the retail user wanting to participate, it reinforces that idea of accessibility.
Okay, but here's the part that sounds quite strict. The anti-flipping rule. If you sell your tokens too soon after getting them within 30 days, you might get smaller allocations in future sales.
Yeah, that's a fascinating bit of behavioral design, isn't it? It's a pretty strong nudge against pure short-term speculation. It signals that Coinbase and the projects launching, they want people who are actually interested in the project long-term. Real users, as they put it. Not just folks looking to pump and dump for a quick profit. It's trying to bake in a longer-term perspective.
But for our listeners, who understand the space, how enforceable is that really? Can't sophisticated traders just find ways around it, use different accounts or something?
That's a fair question, and it highlights the importance of their compliance tech. They seem confident they can enforce it by linking your verified KYC identity, your Coinbase account, directly to your on-chain activity.
Ah, okay.
So if the wallet associated with your account shows that quick 30-day flip, it gets flagged. That flag then impacts your ability to get allocations in the future. This kind of end-to-end tracking, linking off-chain identity to on-chain behavior that just didn't exist in 2017.
That level of tracking, the KYC enforcement, it leads us perfectly into the next big topic. Why this whole thing feels like a major step towards legitimacy and compliance for the industry.
Exactly. Yeah, I mean, the contrast with 2017 couldn't be starker. The big deal here is the institutional-grade infrastructure and those mandatory compliance checks. You remember the ICO days? White papers that looked like, well,
Like they were written in an afternoon. Vague promises, teams vanishing.
all of that.
Yeah.
Well, theoretically, those days are over on this platform. Issuers must provide detailed disclosures. We're talking project roadmaps, tokenomics breakdowns, team backgrounds, vesting schedules, basically everything you need to make a properly informed decision, almost like a mini IPO prospectus.
And since every project has to pass Coinbase's own internal compliance review, that sounds like it should mean fewer outright scams or rug pulls. But hang on, isn't there a potential conflict of interest there? Coinbase vets the projects, but they also profit if the sale goes well.
That's the critical counterpoint. Absolutely. How do you ensure their commercial interest doesn't, weaken the vetting process?
Right.
Their argument, I think, rests on the scale and cost of the compliance systems they've built. This isn't just one person checking a box. They've spent years and a lot of money acquiring companies to build this.
You mentioned Liquify and Echo earlier.
Yeah, Echo, the fundraising platform, reportedly cost around $375 million. Liquify for token management. These acquisitions signal they're serious about making compliance robust, somewhat automated, and central to their reputation and, frankly, their ability to operate legally. It acts like an internal check.
And the broader regulatory signal is huge, too. Coinbase launching this suggests they feel pretty confident about the current environment for token-based capital raising, maybe anticipating a somewhat pro-crypto stance from regulators or government.
It certainly reads that way.
Yeah.
If you zoom out, this platform feels like it's trying to be the bridge. It's taking Wall Street-like structures, the vetting, the disclosures, the KYC, the fair distribution rules, and applying them to the Web3 world of open access.
Structure meets freedom, sort of.
Kind of, yeah. It creates a compliant, potentially scalable way to distribute tokens in the U.S. And that's essential if you want to build trust, especially with institutions, and really move digital finance forward.
Okay, so let's make this concrete. We have the first project launching using this exact model, Monad. The sale is next week, November 17th to 22nd, and then the mainnet launches on the 24th.
And Monad is not a small test case. It's entering a tough arena. It's an Ethereum-compatible Layer 1 blockchain. That means it's positioning itself as a direct competitor to the big players like Ethereum itself and Solana.
High-performance chains. What are Monad's claims technically?
They're ambitious. They're talking 10,000 transactions per second, TPS, and very fast finality like 800 milliseconds, all while being fully compatible with the Ethereum virtual machine, the EVM.
Which makes it easier for existing Ethereum developers to switch over or build on it.
Exactly. And it comes with serious financial muscle. $240 million raised in total, including a huge $225 million Series A round led by Paradigm, a major crypto VC.
That kind of backing definitely gets attention. So the MON token sale itself on Coinbase, what are the specifics?
They're selling up to 7.5 billion MON tokens. That's 7.5% of the initial total supply. The price is fixed at 0.025 per token.
2.5 cents.
Yep. And for retail users, you can request anywhere from $100 worth up to $100,000 worth.
And you mentioned the market's already buzzing.
Yeah, interestingly, even before this official sale, there were some unofficial trades happening on decentralized platforms like Hyperliquid, and the price there, around 6 cents.
More than double the sale price already. Wow. Okay, with that kind of hype, the tokenomics, the structure to prevent early dumping becomes really critical for stability. What does Monad's structure look like?
This is actually one of the most interesting parts of this first launch, I think. Monad has put in place a really stringent locking structure. Over half, 50.6% of the total MON supply is locked up right at launch.
Locked, meaning it can't be sold.
Correct. Can't be sold for a period. This includes big chunks allocated to the team, about 27%, and early investors, nearly 20%. And those are locked for at least a year.
Okay, that tackles the immediate sell-off risk from insiders. But what about staking? Often, early investors and teams can stake their locked tokens and still earn massive rewards, concentrating influence early on.
And that's the other crucial detail here. Monad specifically stated that these locked tokens, that huge 50.6% chunk, cannot be staked initially.
Oh, that's significant.
It's very intentional. It means the initial staking rewards, the yield generated by the network, flows primarily to the tokens that are actually circulating publicly. It stops the team and VCs from immediately accumulating even more tokens and network control via staking rewards right at the start. It directs value towards the broader community, the public holders.
That seems quite well thought out to encourage decentralization from day one.
It does. But, even with all this structure, all this vetting from Coinbase, we have to keep the risks in mind. It's still crypto, it's still early stage tech. Projects can underperform. They can fail for technical or market reasons, regardless of initial vetting. Regulations could change despite the positive signals now. Things can shift unexpectedly.
And human nature doesn't change. Hype cycles are always a risk.
Exactly. If speculation gets out of hand, we could see echoes of the boom and bust patterns again. Even with these guardrails, rational analysis can get overwhelmed by excitement.
Definitely something for you, the listener, to keep in mind. But okay, let's zoom out for the final key takeaway here. What should you remember from this?
To me, it feels like a moment of real maturation for crypto finance. This Coinbase platform seems to achieve two big things. It gives developers a credible, compliant way to raise funds from their community, and it gives retail investors like yourself fair, vetted access to potentially promising projects. It levels the playing field somewhat.
I agree. And maybe here's the final provocative thought to leave you with. Coinbase isn't planning to stop at just crypto tokens. They've explicitly mentioned wanting to expand this regulated model to include tokenized securities and even real-world assets, RWAs, like tokenized real estate, or shares in a fund.
Exactly. So, if this framework works well for Monad and for future crypto tokens, think about this. How much could this regulatory architecture potentially shake up traditional finance if they successfully apply it to distributing tokenized versions of real-world assets globally?
That opens up a whole new world of possibilities and questions. Food for thought indeed. Thanks for diving deep with us today on this major shift. We'll catch you next time.